This model is what we call the macro asset perspective, or the MAP. It's designed to give you a visual representation of where your assets can be placed and why. You see, the vertical arrangement on the boxes represents the concept of vertical diversification. That is, the safe, the moderate, and the aggressive arenas. No matter who you're talking to, whether it's a banker, a financial planner, an insurance agent, a stockbroker, or an accountant, they all speak of these three broad areas of diversification. And I'm sure you would agree that it's a good idea to diversify in some way or another. Now, why is that a good idea? Let me explain. You see, assets accumulated above the line are sometimes referred to as paper assets because their value isn't fixed until the time they are actually sold. When you look at your 401k statement, for instance, if it's invested in stocks or stock mutual funds, you notice the value moves up and down depending on a number of factors, all of which are outside of your control. Of course, we hope it only goes up, but the reality is it moves in both directions. Assets below the line represent real or stable wealth. That is, their values typically do not go down, they remain relatively stable or they're fixed, and usually pay some sort of interest or dividends. Your personal diversification, how much you put above or below the line, depends upon your age, risk tolerance, holding period, etc. But generally speaking, the older you are, the more you might be below the line. In fact, the Wall Street rule of thumb is that a percentage of assets equal to your age below the line. So if you're 20 years old, you might have 20% safe and 80% aggressive. If you're 80 years old, you might have 80% down below the line and 20% at risk. Okay? So, over time, one of the primary objectives of vertical diversification, in addition to managing your risk, is to change the paper assets into real wealth. Now, while vertical diversification has been touted for decades, another important issue has emerged more recently, and this is called horizontal diversification. That is, diversification between tax treatments. That's why there are 6 boxes instead of just 3. This is a fairly simple concept, since there are only 2 types of tax treatments when it comes to savings and investments: pre-tax and after-tax. Now, what do I mean by pre-tax investments? If you can go ahead and just imagine one of the examples. So, for example, let's go ahead and consider your 401k, the deductible IRA, a pension, or profit sharing plans. These are programs where the money you earn is invested before being taxed. So they're what we call pre-tax investments. Everything else pretty much goes over here on the after-tax side, where you save or invest your money after it has been taxed already. Those savings or investments are by definition after-tax assets. Now, for years, when it comes to saving money, people like me have said, you've likely heard, to concentrate our efforts in the pre-tax component, right? Pump all the money we can into our 401ks, deductible IRAs, and anything else considered pre-tax. But why is that such a good idea? What was the advantage? This is a fairly simple concept, since there are only 2 types of tax treatments when it comes to savings and investments. There's pre-tax and then there's after-tax. Now, what do I mean by pre-tax investments? For example, your 401k, a deductible IRA, or a pension and profit sharing plan. These are programs where the money you earn is invested before it's been taxed. So they're what we call pre-tax investments. Everything else pretty much goes over here on the after-tax side, where you save or invest your money after it has already been taxed. those savings or investments are by definition after-tax assets. Now, for years, when it comes to saving money, people like me have said, you've likely heard to concentrate our efforts into the pre-tax component, right? Pump all the money you can into your 401k, your deductible IRA, and anything else considered pre-tax. But why was that such a good idea? What was the advantage? Typically, it's just to defer in a high tax bracket and withdraw later in a lower one. And that's a really good short-term reason, but it's not the correct long-term reason. The strategy has worked. Let me start it for you, and I'll bet you remember it, okay? It goes like this. I'm going to defer my taxes now when I'm in my high income earning years, because later, when I draw money out, I'll be in a what? A lower tax bracket, we imagine, right? And that has been the mantra for over 3 decades. Interestingly enough, though, how seldom people answer correctly these days, that's because very few actually believe they will be in a lower tax bracket in the future. Let me explain the evolution that has taken place. Do you have any idea what the top marginal tax bracket was back in the 80s when pre-tax plans were popularized? Take a guess. The top tax bracket was 70%. And there were 15 different tax brackets in those days. If you earned a little more, you moved up a bracket or two. If you earned less, you dropped down a few brackets. People earning $100,000 in those days were in brackets over 50%. So the thought was, hey, in retirement, I'm going to need $100,000. I can live on $80,000, inflation adjusted, when I'm drawing the money out. And they were absolutely right. For those retiring today, that plan worked perfectly. They deferred taxes 50, 60, or 70%. And they are paying taxes today in only 25 or 28% tax bracket. Today, however, how many tax brackets do you think a couple move down when they go up or down 100,000 to 80,000? It's a big round number. 0. They move down 0. That's because these days there are only 7 tax brackets, the highest of which is 39.6%, with a lot of distance between each one, so it just doesn't work automatically to be in our lower tax bracket in retirement like it used to be. Of course, another real issue these days is possibly of higher tax rates in the future, as some are predicting and as history would seem to suggest. Deferring taxes 25 or 28% only to pay them later at 35, 40, or 50% would be a major mistake. The old mantra isn't working then, is it? So how can we deal with this potential problem? Well, first of all, let me tell you how not to deal with it. Don't run out and cancel your 401k contributions, as some are advising. The pre-tax component can still be a great place to accumulate wealth, if done properly. That is, with proper diversification between your pre-tax assets and after-tax assets. Let's take a look at how that strategy can work very effectively. You see, the plan is to accumulate dollars on both sides of your tax fence. Let's assume you want $80,000 of retirement income annually. Tell me, how is the income stream taxed when it comes out of the pre-tax bag? That's right, it's 100% taxable income. When it's only reasonable, since you haven't paid taxes on the money that went in or the assets that accumulated, of course, you'll pay the prevailing tax rate at the time you draw the money out, which, as we discussed, isn't really a known factor and could potentially be really high. But what if you were able to draw $40,000 per year from each bag? The income from the pre-tax bag would be significantly lower, placing you in a lower tax bracket. In fact, today this amount of income would land a couple in one of the lowest tax brackets possible, making the old mantra work again. You deferred in one tax bracket to pay later in a lower tax bracket. But you wouldn't have to live that low income because of the additional income from the after-tax bag. So ideally, you want all the income from the after-tax side to be tax-free. You've already paid taxes on the money that went into those savings or investments. If you set things up properly, it is possible that you could have a tax-free flow of income coming out. but it doesn't happen automatically. But there are ways to accomplish it. I'll show you how in just a minute. For now, let's just assume you're able to receive all of your tax-free income from after-tax side. What would your total taxable income be? That's right, $40,000. Today, that puts a couple in one of the lowest tax brackets that exists, 15%. Now, I don't know what it will be in the future, but withdrawing a lesser taxable income should put you in a whatever lower tax bracket exists at the time. And historically speaking, lower income brackets tend to stay low. The debate among lawmakers is always about whether or not to tax the rich, not about increasing tax rates on the lower incomes. Assuming no taxes on the after-tax income, that's a total tax burden on post-retirement income of 7.5%, increasing your spendable income when you want it most. After all, the reason we're saving all this money isn't for now. It isn't primarily because we want a tax deduction today. It's because we want to save as much and want to produce as much income as we can when we retire. Does that make sense to you guys? If you have any questions at all, go ahead and send me a message. Let's talk about it. I'm sure there's something that can explain a little better in person or over a Skype call or over Facebook. Well, that's a strategy. Now let me show you some of the tactics. That is how we're going to get this done. All right, now let's take a look at the pre-tax side. Now, we're going to go ahead and just put your 401k on the pre-tax side as certain. Now, what advantages are generally associated with below-the-line assets? What does the S stand for? That's right, safety. How about a money market account or a checking account? What's the advantage there? That's right, liquidity. There's one more though, tax advantages. There are still some tools left with tax advantages. Many of these are found below the line, with tax-free municipal bonds being the standard example. But long-term safety above the line looks kind of like this. This is my highly analytical graph of the stock market. Long-term, the stock market is where you look if you want to outpace inflation. And the longer period of history time you have, historically, the better chance you have of beating it. Now, this is a good place to interject something, a very important principle. It's what I call the first rule of accumulation. And it goes like this. Take the free money. Where might you find free money on the pre-tax side? That's right, your 401k. Within your company plans, you might generally contribute the amount necessary in order to get all the employer's matching dollars. So the key box in our map approach on the pre-tax side is in this area, above the line. Now, if we only do what I've said, that is just invest our money above the line on the pre-tax side, we have a problem, don't we? Now, the problem is going to be this. We're not vertically diversified anymore. And my point was the importance of vertical diversification. My friends, if you haven't heard about Anchor, it's the easiest way to make a podcast. Let me explain a little. Number one, it's free. Two, there's creation tools that allow you to record and edit your podcast right from your phone or your computer. Anchor will then distribute your podcast for you, so it can be heard on Spotify, Apple Podcasts, and many, many more. You can make money from your podcast with no minimum listenership. It's everything you've ever been looking for to make a podcast in one place. Go ahead and download the free Anchor app or go to anchor.fm to get started. Now, do you need tax advantages like tax-free municipal bonds inside a pre-tax plan? No, because income will be taxed according to the plan, not according to the investment, which will all be taxable when it's withdrawn. Assuming you plan properly, do you need liquidity inside a plan that you're not going to touch for 10, 20, 30 years, depending on your age? No, this is not the place for your liquid assets. But how about safety? Do you need safety? Well, sure, you need a certain degree of safety, but what kind of safety? Do you achieve when you place your money below the line? You get day to day safety, preservation of capital. That is, what's there today, you want to be there tomorrow, plus interest or dividends. However, short term safety is not what's needed here. What you really need is long term safety. What do I mean by that? The money you're putting away today needs to be there 20 years from now. And for it to have been safe, it has to have outpaced what? That's right, inflation. Now, historically speaking, assets that keep pace with inflation or have the potential to exceed it have been found above the line. Where do you think we're going to get the vertical diversification? That's right, the after-tax side. To help us achieve vertical diversification, we're going to take advantage of the after-tax side. On the after-tax side, we want to focus below the line. All of these attributes of safety, liquidity, and tax advantages, which had little or no value on the pre-tax side, have tremendous value here on the after-tax side. Just as the aggressive box is the key to pre-tax side, the safe box is the key to the after-tax side. Here, we want to build a foundation below the line with tools capable of providing tax-free income at retirement. Now, those tools are limited primarily to three. I already mentioned one. Do you remember what it was? That's right, it's your tax-free municipal bonds. The second one is a cash value life insurance. And the third is a Roth IRA or a Roth 401k. Each of these, if used properly and you can qualify, can provide future income that is tax-free. By structuring them correctly and following the rules, you can pull out tax-free future income streams from each one. Generally, if a person is at or near retirement, wanting a stream of income right away, we lean toward the municipal bonds. If a person has the time to accumulate, is in good health, and especially if he has others counting on his income, like you, we utilize a cash value life insurance. While the Roth can be used in this box, it's actually more appropriate above the line in most cases, and we don't typically use it here. I'll show you where it belongs in a minute. Generally, we are building a base with one of these. Now, what rates of return would you expect to receive from below the line vehicles? Long term, historically speaking, 4, 5%, somewhere in that range, right? Let's just say 5% long term. But if you're not paying taxes on that 5%, depending on your tax bracket, that might be the taxable equivalent of 7 or 8, in other words. If you earn 8% in the bank and pay taxes on it, you might net 5% after taxes. Now, 7 or 8% certainly isn't bad. However, it's still not what people often hope to get above the line. What do people hope to get above the line? Sure, many people hope to get 10, 12, 15, or even 100% return above the line. But we're not trying to compare the returns of safe, conservative products with the returns of aggressive or risky ones. We're simply trying to ensure that for whatever percentage of our assets is held below the line, we are achieving as much return on our money as possible over the long term. So the safe box is the key box in the after-tax side. Now, many people do and should own after-tax assets above the line. One of the best tools available above the line is the Roth IRA or the 401k. We just saw how it could be used below the line if needs be. But because of its long-term nature, we generally prefer to fund it with equity investments above the line. We just need to make sure we are accumulating sufficiently in the safe arena to permit the use of the Roth in the aggressive component. Another tool is an employee stock purchase plan. For those who are fortunate enough to have access to one, this is another version of the first rule of accumulation. With the 401k match, it was take the free money. With ESPP, it's take the discount. Aside from the Roth and the ESPP, when it comes to this after-tax, above-the-line component, we aren't looking for tax-free income as we were below the line, or free money through a stock discount. Here we are looking for growth, pure and simple, with a secondary consideration of tax reduction through the use of long-term capital gains when applicable. In other words, equity markets. For some people, that means the stock market. For others, the real estate market. It may be business ventures or gold and precious metal or variable insurance products. But the idea is to obtain the paper money growth and to turn it into real wealth by systematically moving gains from the aggressive to the safe component. Perhaps the best systemic method of accumulating this is this is what we call the funnel approach. That is, funneling assets down from the above line to below your line over time. Perhaps the best systematic method of accomplishing this objective is known as annual asset reallocation. That is, once a year, you rebalance your overall assets to get back to your ideal asset mix. This causes you to buy when the market is low and sell when the market is high, the complete opposite of what most individual investors actually do. In other words, if your objective is 50% above the line and 50% below when the market hits, when the market has done well, you may find yourself 60% above the line and 40% below, requiring you to sell some of your profits to get back that 50-50 split. That is, sell high. It works just the opposite in the down market. When your annual asset reallocation causes you to buy low by moving assets upwards, it's a little tougher with real estate because of the inherent illiquidity. But it can be accomplished by funneling income from the assets rather than the asset itself. Does that make sense? Am I being a little bit clear though? Because go ahead and reach out to me. Like I said, down below, let's sit down and let's go over what it is that I'm talking about for you in a more customized, and we can go ahead and explain it further. Okay. So let's go ahead and let's take a look at some of the proper macro asset allocation guidelines. That is what to do with your money. Basically, we look at the total dollars that you have to work with. That is your total investable dollars. A basic approach is to divide it 50-50 left to right on each side of the tax fence. That's a reasonable approach for many people. We don't know what's going to happen in tax rates in the future. We want to keep our balance so that we can lean on one direction or the other depending on what happens or what transpires. While a 50-50 split is probably reasonable for most people, let me give you a couple of exceptions. First, someone who's making a lot of money and expects to maintain a high income in retirement. If you're making $400,000 now and want $300,000 in retirement, you probably don't want $150,000 coming out of the pre-tax side, because $150,000 is not a low income and is not likely to be taxed in a low tax bracket. And it could even be taxed at a higher rate than it would be taxed today. So if you're not concerned about that, you would want to lean heavier on the after-tax side. Frankly, you'll end up that way anyway if you're doing a good job of investing, because you can only contribute so much on the pre-tax side. And if you're making that much money, hopefully you're investing a lot of it. So you might be more like 30% and 70% after tax. Conversely, if you have a household income of $30,000 and you're hoping to retire someday on $20,000, you will probably always be in one of the lowest tax brackets that exists. So you may still do what the most national newspapers and magazines who are targeting Joe and Jane average are saying. That is, you could still lean heavier on the pre-tax side. Now, if you're somewhere in the middle, then the 50-50 horizontal split is probably reasonable. And we already said in most cases that the whole 50% on the pre-tax side could go above the line. On the after-tax side, you would split the remaining 50% according to your own personal risk factors, using the Wall Street rule of thumb we discussed earlier. A 50-year-old or even a conservative 40-year-old might put this whole 50% below the line, giving him a 50-50 diversification both horizontally and vertically. An average 25-year-old or a more aggressive 45-year-old could put 25% above the line and 25% below the line. So that works out too. Then, when you look at the complete picture, you would be at around 75%, he would be at above 75% above the line and 25% below the line, which is as aggressive as just about anybody would recommend. Does that make sense? So you see, I found that most people have pretty good handle on the upper left area. You see on the 401k and those kind of directions. Often they have at least a fair understanding on the upper right hand too with the Roth, right? But many times there is a lack of knowledge regarding these tools on the lower right. How would you classify your own understanding level? If you would like to go ahead and see if there's something that you want to find out more about finding how to fill that gap, how to protect yourself on the safe side of the assets, I can take our remaining few minutes to give you a little understanding on how the cash value life insurance works. Go ahead and reach out to me and find out how it can fit the need that you might be overlooking. It won't take too long, and you can go ahead and schedule right away. Click on the link below and let's get going. Thank you.